your thoughts on Pick n Pay? We've had a discussion, a relatively robust discussion, post the interview with Nick Badmington. Do you like the stock at 42 Rand?
No, we don't. We don't like the sector as a whole. I think if you look at ShopRite, Checkers and Pick n Pay, they're both very expensive on a PE. You're looking at PEs of around 20. That's quite expensive for a retailer. We obviously look at the two companies, ShopRite and Pick n Pay, and compare them. And looking at ShopRite's results out a few months ago, they were able to maintain their profit margin, whereas Pick n Pay weren't. And I know there were reasons put out for that. We feel, however, that they've franchises, their earnings contribution from the franchises has increased a hell of a lot compared to their corporates. Their operating or profit margin rather on their franchises sits at about 5%. So we think they've lost some profit margin through increasing their contributions from their franchises, which is in contrast to what Woolworths are doing, where Woolworths are rather trying to pull away from their franchises at the moment. So in all, we don't like the sector, and no, we don't.
Well, I know what you do hold is Value Group, and
yes.
Although it's a small stock, it did come out with, as you said earlier, satisfactory first half results. Can you give us a little colour around Value Group?
Yeah, Value Group, that's a distribution, warehousing, logistics company. It's a very small cap, it's about 700 million. That's the beauty of being a small manager. You can play in that sort of space in the market. It's very illiquid, hard to trade, but we do hold it, and we have held it for some time. It's a very attractive little share. It trades on a price to book of 0.7, which is extremely attractive for a value manager. The results were satisfactory, as I said. Their headline earnings per share was up about 7%. Now, obviously, that includes the World Cup, which was beneficial to them. But then again, on the other side, there was a Transnet strike, which counted against them. But valuation metrics, extremely attractive.
And this is a long-term hold.
This is a long-term hold. And they've also just completed a 60 million rand share buyback, which for us, when we look at our research, companies that tend to repurchase their shares tend to outperform in the long run. So that's a plus for them from our side.
Chris, Value Group's not on your radar screen, is it?
Nope, no, it's a bit small for us, but someone asked me the other day, what's the next Capitec? And maybe something like that is, So, they're very difficult to analyse these small cap stocks, and management isn't always that forthcoming.
And it's whether you can find that 10-bagger or not.
Exactly.
Let's talk about the earnings season that we're seeing unfold in the US. We did see Yahoo last night surprising on the downside in terms of their revenue expectation, but the stock is trading up today. Generally, we're looking for that theme, as I've said repeatedly on this show, for the top line growth to come to fruition.
Yeah.
Are we standing, which side of that coin are we standing at the moment in terms of the results that have been reported?
If you look at the Bloomberg consensus over the past few months, you tend to find that the actuals have been surprising on the upside. And as I take your point, Yahoo's.
But it's from a profit perspective.
Yeah.
So I think 70% of the companies that have reported to date have surprised on the upside in terms of profit, not in terms of revenue.
Yes, and that's the point I'm going to make, is that if you look at the underlying economy, what is happening is that you're getting so many companies who have been able to cut costs, and unfortunately that means at the expense of people in terms of employment. So your employment figures are staying stubbornly high, but profits are rising. So companies in the US are getting incredibly productive. There's a limit to how long that can continue. As Wendy Lucas-Bull said many years ago when she turned First National Bank round, any fool can cut costs. It takes somebody with vision to grow the top line. And you're right, that's the problem. So that the US may run into a problem 6 months, a year down the track when they've run out of the ability to cut costs.
What are the thoughts, Cannon Asset Managers, around the quantitative easing? The market has been fixated on the quantitative easing, QE2 as they're referring it to. We will have more clarity November the 2nd, November the 3rd, when the FOMC comes to the table, hopefully with clarity on the size of quantitative easing. But the point has been made that they need significant amounts of quantitative easing at this stage to make any difference to a pretty dire situation.
Yeah, I think history shows us that central banks generally are pretty good at preventing bubbles, not trying to increase investment in the economy. You look at the Great Depression, I think it was, they had no chance of trying to inflate the economy by using quantitative easing. So I think they're going to make a mistake again from that regard. So from our side, we think that the Federal Bank is definitely making a mistake here. This is going to translate, you've seen their money supply. Their money supply, I think, doubled over the last 2 years. This is eventually one day when lending does regain itself, you are going to see inflation coming to the forefront, and a very weak US dollar.
Andrew, there are a lot of value managers out there saying you need to look to the developed environment for stocks that are offering value at the moment, when we see emerging markets they are saying, bubble territory.
Yeah.
Your thoughts, and are you embarking on a developed world strategy?
We do have a global equity fund, and for some time we've been overweight emerging markets. Recently, when I say recently, towards the beginning of this year, we started moving towards the developed markets. We are seeing very nice opportunities in developed Europe, especially after Greece, Portugal, the debacle there at the beginning of this year, where stocks were very hard hit, and the US at the same time. We are still underweight developed markets, but we are decreasing that underweight position at the moment.
In terms of your thoughts there and your developed world exposure, Greece, Portugal, US thrown into the pot, is that right? Am I using them?
We're not holding shares there, but in developed Europe, Germany, France,
in developed Europe,
for example, yeah.
Yeah, I mean, look, if you look at the US and look at the S&P, I mean, the index is pretty much where it was a decade ago. Okay, the PE is probably a bit lower. So there is a certain attraction at this point in time. But as I said before, there's a limit to what you can do in terms of improving profitability. At some point in time, if you don't get the US economy really starting to gain some traction, then I don't think you're going to get any profound and sustainable earnings growth coming through. So this may be a bit of a flash in the pan.
The market reacted globally yesterday very negatively to the Chinese increasing their one-year deposit rate by 0.5%, bringing it to 2.5%. The knee-jerk reaction that we saw yesterday, potentially overdone, because now we're seeing a recovery in the global equity space today, and we are expecting, as I've said, the Chinese third quarter GDP number out tomorrow, and consensus numbers lie somewhere at 9.5%. It's a robust number. It's not anything to get into a panic about.
No, they probably will produce a number around there because they say they will. China says they're going to do 10%, they'll do 10%. This is the bizarreness of this. Everyone thinks that China is going to bring the world economy out of recession or help it with the recovery. They're growing at 10%, 9.5%. A 25 basis points increase is not going to do too much harm. We don't see from our side at all.
It's Chinese authorities being prudent at this stage,
exactly,
and preventing the economy from overheating.
Yes, that's it. So,
Chris, in terms of the commodity, because obviously the commodity story relies on China. We saw how heavily commodities sold off yesterday because they thought, now Chinese growth is in trouble. That's not the case.
No, it's not the case. And I mean, it's not just China. You're talking about India as well. You're talking about Brazil coming back into the picture, and you're talking about Russia and many other countries. And let's not forget that China's focus has shifted away from purely being export-driven to being much more inwardly industrialization focused. So they're using more and more and more of the kind of commodities we saw earlier, things like copper, for example. So, yeah, I'm not at all bearish on the outlook for commodities, and quite the reverse, in fact.